And we're back. And so we are going to get started. And again, please hold your questions to the end of the presentation. I will also be fielding questions from our streaming audience, and we will have a roaming mic to make sure that everyone in the room is being heard by the individuals that are actually online. Again, a warm welcome for Kimberly Turner-Zorn.
Thank you and good afternoon. It's always such a pleasure to come back to the university. I will confess that most of my happenings went on at the Dearborn campus. It was a wonderful experience. I had some fantastic professors who were here, they were there. I'll never forget it. Thank you for this kind invitation. I'm always happy to come out and speak to people and try to answer questions. I do appreciate very much holding questions till the end. If you need to jot things down, feel free. There are always a lot of questions. I'll do my best to answer everything for you that I can. If I can't answer it here, we'll get you an answer from the office. Okay, we'll begin today with the ever popular Medicare. Medicare entitlement is not part of our agency. We are Social Security. Medicare is Medicare, separate federal agency. However, we have a role to play at Social Security in Medicare entitlement. It is our job to enroll you in your Medicare A and B, or disenroll you, as the case may be, in your Medicare A and B. In order to qualify for Medicare, you must be age 65 or older, or be entitled to Social Security disability benefits for 24 months. So the only way to get it younger than 65 is to be on disability, or, in these very special circumstances, be diagnosed with ALS, more commonly known as Lou Gehrig's disease, have permanent kidney failure, or be on a dialysis treatment, or experience a kidney transplant. There's only one other way. It's not something I've done, and because I'm talking about it today, I'll have to do it tomorrow, I'm sure. Exposure to environmental health hazards. There are very specific enrollment periods for Medicare, A, B, C, and D. That is determined by Medicare. Their policy, their law sets those enrollment periods. We must follow those enrollment periods and entitlement months as dictated by their policy. There are 3 general enrollment periods for Medicare. Your initial enrollment period at age 65, a special enrollment period if you happen to be currently employed, fully covered medically. You may not need to enroll in Medicare A and B at 65. You get another opportunity called a special enrollment period if you are still working past 65. There's also what we know as a general enrollment period that occurs every year in January, February, and March. That's for people who might have missed, unfortunately, their initial or their special enrollment period. If you enroll in your general enrollment period, your Medicare will not begin until July 1st of that same year. As I mentioned briefly, Medicare does have 4 parts. Medicare Part A, if you have worked and paid in your 40 quarters of coverage, you will not pay for Medicare Part A. That will come to you free, and it covers basically inpatient hospital services. There is a deductible for that Part A, and in 2017, that deductible is $1,316. Medicare Part B is the one that you're hearing a lot about on television generally. Together with your Part A, we say that they cover you about 80% of your medical needs, okay? It covers things like doctor's visits, medical testing, outpatient kinds of things. They go into coverage after the first $183 in approved charges. There is a monthly premium. The standard premium for 2017 is $134 per person per month. If you are receiving money from us, if you are receiving disability or if you are receiving retirement, we will withhold that Medicare Part B premium from your monthly payment from us. If you are paying only for A and B and you do not have any money benefits from us yet, you will be responsible for paying that $134 a month directly to Medicare. They have several different ways in which you can pay, and those arrangements are made with Medicare. Medicare Part C and Medicare Part D, you are inundated with mail as you approach age 65, with television commercials. Everywhere you go, you are inundated with Medicare Part C and D information. In many, many cases, in my experience working with University of Michigan employees and retirees, you may not need Medicare Part C. I always defer to your benefits department, but that is a fairly typical scenario depending on your employment with the university. If you need Medicare Part C, you must enroll through an insurance carrier, a private insurance carrier. Part C helps pay for what A and B do not cover. Part C is often called a Medicare Advantage plan. I will tell you from my own personal experience with my parents that Medicare Part C is offered in another way, and it is something that you can ask Medicare about because they don't talk about it very often. It's called a traditional Medigap plan. It is very important if you live in 2 states. If you have a home in 2 states and you regularly travel back and forth, it would be very important before you enroll in a Part C plan if you need it to find out if your Advantage plan will work in both states or if you need a traditional Medigap plan. Okay. When you join a Medicare Advantage plan, you're going to get your benefits and services under the Part A, Part B, Part C, and in most cases, Part D through that insurance carrier that you buy your Part C coverage from. Part D of Medicare is always the prescription drug program. Again, depending on your employment and your retirement contract with the university, you may or may not need that Part D coverage. We need you to check that out. It's not something we can know. We can only tell you generally what we see when we see retirees in our office. Part D covers a major portion of your prescription drug cost, covers out-of-pocket costs like your premiums, annual deductibles. All of that varies by plan. It depends on the insurance carrier. And again, you enroll in Part D coverage through an private insurance carrier. If you're thinking about family members who may not have the kind of coverage that you will have in your retirement, it's important information, especially for them. If you have a senior in your neighborhood or in your family who struggles to pay for their drug costs, there is an application that can be filed online on our website to help them pay for that Part D coverage. It's called Part D Extra Help. It's an income and resource-based plan. The easiest way to file this information is on our website at ssa.gov, but it is something that we can help with in the office if you should need assistance with that. There are also paper applications that can be filed to see if you can get that assistance. If you receive full extra help, it's going to have a value of about $4,000 per year. All right, we're going to move on to qualifying for retirement benefits. In order to qualify for monthly retirement benefits, when you stop working, you need to earn Social Security credits. Some people call them points. If you call them points, we're going to know what you're talking about. We call them credits. You can earn 4 credits in 1 year, and in 2017, in order to earn a credit, you must earn at least $1,300 per quarter of credit. You can earn a maximum of 4 per year. So in 2017, if you want to earn your total 4 credits for the year, you must earn at least $5,200. Earning 40 credits for a year times 10 years of work throughout your working life will qualify you for a monthly retirement benefit from our agency, as well as free Part A Medicare. When I started with the agency in 2005, we used to talk more about what would be advantageous for you in terms of advising you on enrolling in your monthly benefits. But the world has changed a great deal since 2005, and we no longer advise people on when to file. It's a very personal decision. It depends on life expectancy. It depends on if you need the money or not. It depends on your medical care or your medical needs. And it depends on how far out you're going to need those benefits. More and more people are working later and later to maximize their Social Security benefits and to have a greater amount as they go through and age throughout the years. We do have online retirement options. It's a wonderful program. They've just updated the website in the last 10 days. I have not gone on to try the new applications yet, but it's easier than you think it is because the questions are conditional. As you answer the question, the next one pops up. So you might be surprised at how easy it is. Age 62 is the earliest that you can possibly retire with our agency. At age 62, you would receive a reduced monthly payment because you're taking your benefit prior to full retirement age. And you have to meet the definition of retirement. We generally define retirement by an amount of money that you're earning. At full retirement age, you're going to get your full monthly benefit. If you're looking at your statement online or if you're still receiving a statement in the mail, you can look at your full retirement age amount. If you choose to wait after your full retirement age, which generally speaking is age 66, you can actually receive a higher monthly benefit. If, for example, you were born between the years of 1943 and 1954, at age 62, you would receive approximately 75% of your age 66 benefit. At age 66, you'll receive 100% of your benefit. If you wait to file until 70, you'll receive approximately 132% of the benefit. A common misconception that I see in the office all the time is that these are the only ages at which you can retire with us. But you can retire at any time after age 62. We compute your benefit on a monthly basis. So we count the months. You can retire at 62 in 3 months. You can retire at 65 in 6 months, whatever works for you. In addition to retirees, we also pay benefits to a retiree's minor child. That would be generally unmarried and under age 18. However, we can pay as high as 19 and 2 months if that child is in high school and we can get certification from the school. Additionally, if there is a child who became disabled before age 22 and we find them medically disabled according to our rules, that child may continue to receive benefits on your retirement record. Your spouse, age 62 or older, may also be able to file on your Social Security record, or a spouse who is any age if they are caring for a child who is under age 16, or you have a disabled adult child for whom that spouse provides care. An ex-spouse can receive from your benefit. You have to have been married at least 10 years prior to the divorce. Your ex-spouse has to be 62 or older. You have to be divorced at least 2 years, and both of you 62 if the primary earner has not retired yet. If you're currently married and your wife wants to draw from you, for instance, you have to be drawing as well. An ex-wife can file even if you are not yet drawing. If you are both age 62, you were married 10 years prior to that divorce. A former spouse's benefit amount will never ever affect what the worker receives. When we figure out your benefit, we figure out your personal monthly amount, and then we figure out a family amount for you. And a child, a minor child, a disabled child, a current spouse is paid within that family amount. A former spouse is paid outside of that family amount and will never affect your benefit. In addition to retirement benefits, we also pay survivor benefit. Your child who is unmarried and under 18 years old or under 19 and still in school can receive surviving child benefits, or a child unmarried and disabled before age 22. A widow or widower may receive as early as age 60. But you have to be under that earnings limit, just as if you were filing for early retirement. As a widow, if you wait until full retirement age, you'll receive a higher benefit. If the widow is taking care of a child under age 16 or a disabled adult child, they can be paid at any age. Here's an important point. If you have remarried after 60 or after age 50, if you are disabled under our rules, you may continue to receive that widow's benefit even if you remarry. But the secret is marrying after age 60. And also, a divorced widow or widower may qualify again if they meet the 10-year duration of marriage requirement. At full retirement age, 100% of the deceased worker's unreduced payment can come to you if you wait until full retirement age. If you take a widow's benefit at the first possible moment at age 60, the computation is 71.5% of the deceased worker's full retirement age amount. We call it unreduced amount here. That's always full retirement age. Reduced benefits on one record can be at age 60 and say you're receiving a widow's benefit at 60. You may qualify for a higher benefit on your own record at a later age, and we can move you over with an application at that point. Whatever is most advantageous for you is what we do for you. Full benefits can be paid to both a widow or a widower and a divorced widow or widower. So as long as you meet the 10-year marriage duration and everything else is equal, we can pay you that. This is an unusual situation. I've only seen this a couple of times in my career. A parent may be able to receive a benefit on a surviving child's record if that parent was age 62 or older and was receiving at least 1/2 of their total financial support from the deceased worker, the deceased child. In addition to monthly benefits, we also pay a lump sum death benefit that is a one-time payment of $255. And that generally, if you are a spouse, you would qualify for that. If there is no spouse and you pass away, if you have a minor child, they can qualify, or a disabled adult child, they can qualify for that benefit. Online filing is something we started a few years ago, and it's a pretty wonderful program. If you come into our office and you want to file a fairly simple retirement claim, we're going to ask you if you want to sit down at our front desk and file one of these claims online, because you will have a claims specialist standing nearby to assist you if you need help. Anytime you want to go to our website, please be sure that you are using .gov. It must say socialsecurity.gov. There are fraudsters out there who have look-alike websites, and they fool sometimes the best of us. So always make sure that you're using .gov. We no longer send out yearly benefit statements telling you what you're going to get at 62 or 66 or at 70. If you are age 60 and you do not have an online account, you'll still get a statement. Everybody else, you need to go online with our website and file for what is called My Social Security. This is an online account. It's a very personalized account just for you. You create your own password, your own username, and you have access from anywhere you can access the internet. You can look at your own statement of earnings. You can, once receiving your benefit, print all kinds of different things out of that website. I did bring some information on that with me, and it's out on the table. We have little cards, which I thought I brought up here, but is missing, but they're on the table and we can show you those. In order to open a My Social Security account, you must be at least 18 years old. You have to have a valid email address. You have to have a Social Security number, and you have to have a U.S. mailing address. It's very simple to do. If you are not yet receiving Social Security benefits, you can request a replacement Social Security card. That's a new thing. Michigan is one of the first states in the United States where we allow this to happen. You do have to have a My Social Security account in order to access this. We have seen people doing it from our online service windows in the office, and it's pretty cool. So you might not even have to come in. If you have all the correct IDs, you can go online and give it a shot. You can also, again, view your statement that we used to mail you every year. You can look at the family benefits on that estimate. You can verify your earnings. Now, this is really critically important. If you have young adult children, if you have young adult grandchildren, they're not going to get earnings statements like we have all of our lives starting at age 25. They need to sign up for My SSA. It's the only way for them to check that their yearly earnings are posting to their Social Security record. So keep that in mind if you've got a young adult in your life. You can also look at your Social Security and Medicare taxes that you've paid in. That would be on your My SSA account. Find out how to qualify and sign up for Medicare, and view, save, or print your online statement. If you do get benefits already, you can again request a replacement Social Security card. Check your payment information to verify that it's gone out. You can change your own address and phone number, start direct deposit, change direct deposit, request a replacement Medicare card, and if you need a replacement 1099, if you've misplaced it and you're going to file your taxes, you can go right in to your MySSA account and print that again. There's a new law that went into place November of 2015. It became effective April 1st of 2016. So we're going to go over that just a little bit. If at the end you have specific questions, I'll do my best to answer those. If you are eligible for benefits both as a retiree yourself and a spouse, you must file for both benefits. You must. This deemed filing used to apply only before age 66, but now it will apply at any age if you reach age 62 after January 1 of 2016. Some of you look a little confused. You may not have been aware of this in the first place, so that's something that we can go over. It did affect some people, others not so much. There was a loophole in the law which was closed as of April 1. That same law also changed voluntary suspension. In the past, if you were full retirement age and you wanted your spouse to draw from your record because they either didn't have an earnings record or they were full retirement age and wanted half of yours instead of taking their own, you used to be able to file and suspend your benefit and allow that spouse to draw on your record. Even though your money wasn't coming to you, it was in suspense. See, it is April 30th. I was right the first time. Now that won't be happening. There are a few people who are grandfathered in. Those people would have had to have been born before January 2nd, 1954. And again, that was a loophole that occurred due to successive legislative changes. It was never intended to be there, and some people have been able to benefit from that, but the agency did feel it was important to close that loophole as good stewards of our retirement and disability trust funds. This is a very simple chart of full retirement age. It used to be that everybody's full retirement age was age 65. So if you were born in 1937 or earlier, full retirement age was indeed 65. Every year after that, it went up 2 months till you reach the birth years of 43 to 54. Everybody in that birth year range is a full retirement age of 66. Starting with 1955, it goes up 2 months for every succeeding year. If you were born like me after 1960, you got to wait till you're 67 for a full retirement age benefit. There are formulas involved in determining your Social Security benefit, and so we brought along some information with that. Everybody's is a personal amount. It's based on your earnings and what you have paid into our agency. First step, we look at all of your wages and we adjust them for changes in wage level. So it's kind of like adjusting for inflation. We call it indexing. So if you earned $4,000 in 1965, it's going to be worth a little bit more once we raise that up for inflation. At step 2, we find the monthly average of your 35 highest years of earnings. Most people don't realize it's 35. They worry that it's the last 5 or the last 3, but we literally look at the highest earnings for 35 out of your 40 years of earnings. At step 3, that average is called an average indexed, because we've raised it up for inflation, monthly earnings. So if your average is $5,500, your monthly benefit would be $2,197 a month. We're going to break it down a little bit. We take for everybody, with few exceptions, and that's a very solid exception for people who have worked under other retirement systems, we take 90% of your first $856 in earnings. So that figure is $770 over on the right. Are you following? At the next point, we take 32% of earnings over $856 up to that $5,157 amount, okay? That's a stated amount. So $5,157 minus $856, $4,301. Take 32% of that, and that comes out to $1,376. We finally then take 15% of earnings over the $5,157, which is $343, 15% of that, $51. We total all of that up, $770, $1,376, $51, for a monthly payment of $2,197. I, for one, am glad that I don't do that by hand. The computer helps me with that. If I have to, I can, but it's nice to have a computer do it. A spouse's computation, a living spouse, is always 50% of the age 66 benefit. We reduce it for taking the benefit prior to 66. If a spouse's own benefit is less than 50% of the worker's benefit, we're going to combine them. We do not reduce a payment to the worker at any time for any auxiliary, not a spouse, not a child. The worker is the primary person that we pay, and that benefit is never reduced. Online, we have something called a retirement estimator. It's pretty fabulous. If you go to the website socialsecurity.gov/estimator, it should take you right there. It's also, I believe now, and I haven't been in my account recently, it may also be inside of your My SSA account that you establish with us. I brought something on paper though, because it's kind of fun to have it on paper. So out on the table in the hallway, we do have a sheet that tells you exactly how to put in your wages, how to index them. It gives you an example of how we do that. The retirement estimator online gives you an immediate estimate. It's very accurate. And it lets you put in different what-if scenarios. Well, what if I want to take it in June of 2016? What would my benefit be? What if I want to wait till March of 2017? What would my benefit be? It allows you to change those dates and figure that out yourself so that you can figure out what's beneficial to you. Our computations are really designed to give a great rate of return for people who work steadily all across their lives, okay? A low earner has a greater rate of return than a high earner. That was a deliberate computation done within the program itself. So a low earner, say, will receive about 55% of their pre-retirement earnings from Social Security. A medium lifetime earner, about 41%. A high earner is going to receive about 34% of their pre-retirement earnings. When I talked about that screen where I said we're going to take 90% of that average index monthly figure, there are some people very specifically where we don't use 90%. And that's what windfall elimination provision is all about. So if you had another job outside of the Social Security earning system, so if you had a government job where you weren't paying Social Security taxes, it could be federal government, local government, city government, teachers. In the state of Ohio, teachers do not pay into Social Security. So they would be affected by this. Police and fire in Detroit do not pay into Social Security while they're employed by the city of Detroit. It affects people like that. IPSC and Ann Arbor Fire and Police at points in the past have been affected by this. I'm not sure what they're doing now, but it's definitely something that if it affects you, I think you're going to know about it, okay? So what happens is that in the normal computation, instead of the 90% of the first $856 of earnings, we could drop that as low as 40% of that first $856 of earnings. At the 32% mark, it remains the same if you are in the windfall elimination, and that 15% of the remainder, that also remains the same. It's just that first point at which we do the percentage work that it could change. There is an online calculator. If you find yourself in this situation, it's called the online WEP, W-E-P. We have acronyms for everything. I'm sure you understand that. And that allows you to estimate what your benefit would be if you will be affected by this. Now, instead of going all the way down to 40% from the 90% factor, you may be somewhere in between 40 and 90%. That is determined by something we call years of coverage. Years of coverage are different than quarters that you're earning every year. It's a different dollar amount that you have to earn a year of coverage. So we might, instead of 90%, we might be doing 85% or 80%. It's a sliding scale depending on those years of coverage. There's another specific type of spousal change. This has been it's been going on a long time. It's not a new thing, but it changes how much you receive from our agency. So, for instance, you're a spouse. You worked for the federal government in the old days and you did not pay into Social Security. Now you want to draw half of your spouse's Social Security benefit. Well, we may not be able to pay you that full half if you have a pension already from your own work outside of the Social Security system. We look at 66% of your outside pension, and I kind of tell people I lay that right over their spousal benefit and see if there's any remainder to pay you. That's called government pension offset, or a GPO. Again, 66% or 2/3 of that government pension will be used to reduce your spousal benefits. For example, if $1,200 of your government pension is your total government pension, we'll take 2/3 or $800. If you qualify for $750 on your spousal benefit, you would receive no payment from Social Security. You would be entitled, but you wouldn't be paid. And again, you can calculate that yourself on our website. It is possible to retire with the agency and still work. If you are any age under age 66 or full retirement age, you are limited to how much money you can make. In other words, you have to be retired, meet our definition of retirement, in order to receive a monthly benefit. In 2017, the definition of retirement is earning less than $16,920, or divided by 12, $1,410 per month. Those are gross figures, they are not net figures. If you filed with us believing that you were going to be under that earnings limit, no problem, and then you go over, you're going to owe us $1 for every $2 you went over. If you went over the limit by $2,000, you're going to owe us $1,000. However, we want to help you not owe us any money. So if you're working and getting reduced retirement because you took it before 66, call us every year in January and tell us what you expect to earn. We'll put on an earnings estimate to your master record, and we'll figure out how much you would owe us by the end of the year. And instead of paying you, say you're going to owe us 4 checks, we won't pay you the first 4 months of the year, and then we'll pay you for the rest of the year. So we're more than happy to work with you. We just have to have communication with you, and then we're happy to help out. If you reach full retirement age year, you have a much higher earnings limit. You can earn in the months prior to turning 66, you can earn up to $44,880 for that total period, or that divides out to $37.40 a month. And remember, those are gross figures. If you go over that limit in the months prior to turning 66, you'll owe us $1 for every $3 you go over. The month you reach full retirement age, doesn't matter what day of the month you were born, the month you attain age 66, there is no limit to what you can earn. So even if you retired early and you had to keep working part-time, and you had to limit it, the month you turn 66, you can earn whatever you want to do. If we have had to withhold earnings throughout the years because you were earning a little more than you expected when you filed for retirement, at full retirement age, we recompute your benefit at 66, and we will give you credit for the months where you were entitled to a benefit but didn't receive it because you were earning too much money. So you get some of that money back. We also pay Social Security disability. You have to meet the definition of disability. It's a medical condition or a combination of impairments that prevents you from working at substantial gainful levels for 12 months or more, or expect to result in death. I tell people in a kind of easier way to understand it that retirement credits never expire, but disability credits expire. It's just like an insurance plan. If you're no longer paying in, you're only going to be insured for so long. So if something happens to you, you don't want to wait too long to come in and talk to us about filing for disability benefits. The other thing that people don't always know is that if you have filed for retirement early and you become disabled a year or two later, you can file for disability even though you're getting retirement. If you meet our medical definition of disability, we can raise your benefit up to a higher monthly benefit based on that disability. In order to get disability benefits, a worker who has paid into Social Security for 5 out of the last 10 years may qualify. If you're a younger worker, the rules are a little different. If you're under age 31, less work and paid into our system is required. If you are receiving Social Security disability, again, your child might qualify for benefits as well if they are unmarried and under age 18 or under 19 if still in high school, or an unmarried disabled adult child could receive on that record. A spouse can receive on your disability record if that spouse has reached age 62, or if the spouse is caring for a child under age 16 or disabled, or a divorced spouse may also qualify. Probably not surprisingly, you can apply for disability online as well at our website. You need to be age 18 or older, have that medical condition that prevents you from working, and you need to reside inside the United States or one of the U.S. territories or commonwealths. I want to stress that when you apply for disability online or retirement online or spousal benefits online, they don't just disappear into the ether, they land on someone's desk. So a claims rep, like me, will receive your application and will review it and look for any problems or missing information and will assist you in getting that filed completely. To apply online for disability, you complete the disability application. You complete a disability report where you list your doctors, hospitals, all of your disability, and then you sign a form electronically online which gives us permission to request your medical records. To file for retirement or disability, you go to www.socialsecurity.gov. You can call us on our 800 number to schedule an appointment, and you can apply at your local office. You actually can apply, you can have an appointment on the telephone, so if you're very ill and unable to leave and come into the office, we will do a telephone appointment. If you're in the hospital and you're unable to leave the hospital, we can do that over the telephone as well. Again, they've just updated the website. I'm not positive if this is the brand new updated picture from 10 days ago, but once you go to our website, I think you'll find it's pretty easy to navigate. It's very clear. When you're going to file for Social Security, you need to have the Social Security number of anyone filing, proof of age available in case we need it. In many cases, we don't need it, but there are times when we will need to see an original or certified birth certificate. We want you to have available your latest W-2 or a self-employment tax return. If you want, you can have your earnings estimate available to make sure things are looking good. We also require direct deposit now. The U.S. government requires all people receiving benefits to receive it by direct deposit. We're going to ask you in that application about marriages and divorces, and we're going to ask if you've served in the military or if you've ever worked for the railroad. Railroad has a separate retirement program, and it's important for us to know that. You need to know that your Social Security monies can be taxable. When you combine your Social Security payments with your total income coming in, so pensions, dividends, any kind of money that you have coming in, you may have to pay Social Security taxes. In order to do that, we provide you at the end of every year with an SSA 1099. So kind of like a W-2, only it's from our agency for your retirement benefits. You'll use that to fill out your tax return. Again, if you've lost it or the dog chewed it up or you've spilled your breakfast coffee on it, you can print that online yourself at home. Again, online services, retirement and disability can be filed. Medicare can be filed. The extra help with that prescription drug plan of Medicare can be filed online. You can use the retirement estimator, review your Social Security statement, and you can look at a planner, which is kind of nice too. There are links for retirement planners, survivor planners, and disability planners. You can request that replacement Social Security card because you're lucky enough to live in the state of Michigan where we're prototyping that. And if you're receiving a benefit already, sometimes a bank or a mortgage company will ask for a benefit verification letter. Since you don't have a pay stub to show them, you need something from Social Security to prove how much money you get every year. That benefit verification letter can be printed at home. Again, you can change your address and phone number, start or change your direct deposit, replace your Medicare card, or get that 1099. There are approximately 60 million people in the United States today receiving Social Security. About 8.9 million of them are disabled workers. 1.9 million are dependent children or dependent spouses of those disabled workers. There are 4.2 million widows and widowers receiving benefits from our agency, 1.9 million children of deceased workers, and about 40 million retired workers, and 3 million of their dependents, minors or spouses. Social Security operates because people working today are paying in. It used to be that there were quite a few more people paying into Social Security workers than there are now. I'm going to get that figure for you. The U.S. birth rate has gone down. You can tell that in 1920, there was kind of a peak, and then after World War II, there was another peak in U.S. birth rate. And then you can also tell that it took quite a dip, mid-70s and 80s. It's been fairly level since then. However, the truth is that there are less people working and paying into the Social Security program than there used to be. And we are also hitting kind of a bulge in that population. Our baby boomers are all coming to the retirement age at this point. In 1960, there were 5 workers paying into Social Security for every 1 person drawing benefits. In 2016, just last year, there were 3 workers paying in for every Social Security disability or retirement worker. And we anticipate that by 2035, there will only be about 2 workers paying into the system. In 1946, people aged 65 and older only made up about 7% of our U.S. total population. Last year in 2016, people aged 65 and older made up about 15% of our total population. And we're forecasting at our agency that by 2035, about 21% of our total U.S. population will be age 65 or older. In 2034, if nothing changes in the way Social Security works now, our agency will only be able to pay about 79 cents for each dollar of scheduled benefits by 2034, by the end of 2034. So that's quite a change. There are various things being looked at in government. We've heard several proposals over the years about how to fix this issue or to extend the life of the retirement and disability programs. Sometimes one of those factors that could change would be changing how we give out the cost of living increase. It could be changing how much of your income is taxable for Social Security purposes. Right now, Social Security has a cap on how high your earnings are to pay in. Medicare does not have a cap. Social Security does. Sometimes just raising the full retirement age has been offered as an option. I personally hope that it goes on. It's a wonderful program. When you work at the level I do and you see how important it is to people here in the United States, you realize how important it is for this to go on. We have brilliant minds in the U.S. Somebody's going to figure it out, right? Another economic factor that can affect Social Security is the rate of inflation. At Social Security, we're probably the only source of retirement income that's tied directly to the consumer price index. That's how we determine that cost of living factor. When you're in retirement planning, you're going to want to know something like that because we generally can give a cost of living increase. You will notice in 2009 and 2010 and again in 2015 that we were not able to give a cost of living increase. What most people don't understand is that that's not a decision by the President of the United States. It's not a decision by the Social Security Commissioner. That is determined by formula. The Department of Labor does their thing, spits out a number that goes into a Social Security formula, and out comes whether or not we're going to receive a cost of living increase. I hope that that has answered some questions that you may have had in the back of your mind, or at least given you some background if you haven't retired with us yet, things that you can use to plan your retirement with us. I'm happy to open the floor, and Betty's going to assist with any questions that you may have. I'll answer them to the best of my ability. We also have a table out in the hallway with a great deal of information. So I would encourage you to stop there, pick up pamphlets or brochures that seem to be something that affect you, and I'll hang around for a little while also to make sure that I've talked to everybody that I can. I know we finished a little early. I hope that that's okay. Thank you so much for your kind attention, and we'll open it up for questions.
Thank you very much for your presentation. It was very informative, but I just wonder if you could go back and revisit, I missed the name of something that you have to do if you're going to apply for spousal benefits and your own benefits. You said there was
Oh, deemed filing, that's a word that we use. If you are under full retirement age, you have to file for your own benefit first. If your spouse had not yet filed for Social Security or was entitled but in a later month, this is a tough concept. I'm going to work to see if I can make it pretty clear. You could just wait until you were older to file for that spousal benefit. That is gone. The new law says that if you are filing for a reduced benefit and your spouse files at any time after you do or at the moment you do, you must take your spousal benefit then. So that's the new rules that went into effect April 30th, 2016. It can get confusing, and when I'm working in the office, I pull out my law just to make sure that I don't make mistakes. I'm always there. I'm the technical expert in that department, and so my claims reps do come and double check things for me. If you were born before January 2nd, 1954, you're still under the old rules. So that may apply to you under the old rules. If you were born after January 2nd, 1954, we have to put you under the new laws. Does that help a little bit? Great, you're welcome.
I actually have an online question.
Certainly.
And the question is, will I get a report every year after age 60?
You will if you have not yet gone online with our website and created your own personal account. If you have an online account, a My SSA account, even if you're 60 or older, you will not receive that statement in the mail anymore. So the only time you'll get it after age 60 is if you have not gone online. I do want to add that we feel at our agency that it's a very good idea to go ahead and establish that account online. There is a great deal of identity theft going on now. We see people in our office every single day who have experienced ID theft, fraud. If you go online with our website and create your own account, nobody else can establish it in your name and Social Security number. So it's an important security feature as well. We encourage you to do that.
Thank you for your presentation. Got one
You're
quick
welcome.
question. I'm 63.
Yes.
I'm thinking of retiring, going to retirement age of 66.
Okay.
Which means that getting income over $50,000 or something with the tax. Does that include my spouse's income also?
When the question is, if you're taking early retirement and you've stopped working, you're getting retirement from us, and then your spouse is also getting retirement from us, is that your question? Still working. Yes, there is the possibility that the IRS may require you to pay tax. They look at your total household income. So when you're filing your 1040, you're going to list your Social Security money, your wife's working income, and any other kind of income you may have, and that determination is made then right on the IRS 1040. Good question. You're welcome.
I have an online question.
Certainly.
If my spouse is collecting SS benefits and I am working and my spouse dies, will I collect 50% of his SS benefit, or does it depend on my income or my age?
It depends on all of those things. So excellent question. Did you all hear that question about surviving benefits? So spouse is receiving Social Security monies. Say the husband, the wife is still working and has not drawn a benefit yet, then if he passes, what kind of benefit will she receive? So in other words, we're going to look at various things. We're going to look, number one, at how much your deceased spouse earned, their record. We're going to look and see if your spouse took a benefit early or waited till full retirement age. And then we're going to look at your age. And then we're going to look at your earnings. And we're going to tell you if you're making too much money to qualify for a widow's benefit, and it's that same working limit that an early retirement person would have. So if you're over $16,920 gross per year, you may not be entitled to a widow's benefit, because I could take your application and I could say, sure, let's pay her, but you're not going to get paid. There are some circumstances, however, where if you're working part-time as the widow, maybe you're just a little bit over that earnings limit because you're working part-time. It might be worth your while to file, and maybe we're going to only hold 1 or 2 checks, but then you would get 10 checks for the rest of the year or 11 checks for the rest of the year. So you may be able to work part-time, receive a widow's benefit from Social Security, and make almost as much money as you would working full-time. So it's very individual. Any more questions? Yes, there's a lady right back here. Over here? Okay.
I have a question.
Sure.
It's actually about Medicare.
Okay. I'll do my best. If I can't, I'll let you know.
My question is, since I am over 65, continue to work, did not sign up for Medicare B. When I actually do retire,
Yes, ma'am.
maybe someday, I will have to apply for Medicare B. Number one, can I do it online? And what do I have to show to prove that I have had benefits after 65, so I'm not given some kind of, penalty for not applying when I turn 65?
That's an excellent question, and I'll repeat that for our listeners. If you are currently working, if you have full medical coverage through your current employment, that is the most stressed word in anything I say about Medicare. Current employment, and here's the other one, more than 20 employees at the company, and you don't have a health savings account, then you can delay filing for Part B until such time as you separate from your employment. Now, there is a form that you will fill out. It's available on our website and the Medicare website. I don't know if you want to write it down. It's a CMS 40B like boy. CMS 40B like boy. That's the one that you fill out. And you say, yep, I definitely want Medicare Part B, and here's when I'd like it to start. On our website and Medicare website, there is another form called CMS L564. The university, if the university is your employer or whomever your employer is, will fill out that form. That's the form that is critical to keep you from paying a penalty for late filing. So when you applied for Medicare Part A, we asked you these questions, and you said, yep, I'm working, yep, I have full medical coverage. So you gave us estimated dates of employment and medical coverage, beginning dates. This form, along with that 40B coming into our office, is what you need to prove that we can enroll you and not charge you a penalty. That can be done by mail, by Dropbox, by coming into the office. Medicare Part B, if you already have A, you're not going to really file online because you've already done the application for the A, and the Part B is just an input that we do in the office. So right now, we don't do that online. Does that help?
And will we bring in the university form too?
Yes, you want to turn them in together and keep copies. If you come in and you haven't made a copy, whomever is sitting down and working with you, ask them to make you a copy so that you have that. Yes.
What was that first form number?
Yes, that is a CMS 40B like boy.
I have an online question.
Okay.
Question is, my wife retired at age 64 in 2015. I reached full retirement age in 2018 and plan to retire at that point. How does her early retirement impact her spousal benefit?
It's the question is if the wife is receiving benefits at 64, correct?
Yes.
And just as in this example, perhaps the husband is working a little longer. I'm sorry. And how does her own benefit affect her spousal benefit? Thank you. We always look at what you're entitled to already. If the wife receives, let's see, how do I put it? We're going to compare, let's put it this way, we're going to compare everybody's full retirement age amount. So if the wife took her benefit early, she's not receiving her full retirement age amount. However, that's the figure I have to use to compare to the husband's full retirement age amount to see if she can receive any additional monies. If hers is less than half of his, she'll be due some extra money. If hers is greater than half of his, there will be no spousal money benefit payable. That happens a lot right now. There are many more women in the workforce, many more women with a really great earnings record of their own. So maybe during a lifetime, you won't receive a spousal benefit. You'll just get yours and your husband will get his. But if your husband passes before you still want to come to us because we can pay a higher percentage for a widow or widower than we can in a lifetime case. So even if you're not receiving anything now during life, please call us and come to see us because we may be able to pay you as a widow or widower. Yes,
So if you're age 65, you have to apply for Part A benefits, even if you're still working.
Medicare and Social Security. Oh, I'm sorry, I have to repeat the question. So you're still working at 65. You have full medical coverage. Do I need to file for Medicare Part A? Social Security and Medicare, we don't care so much, but your employer may care. So you want to take your cue from your employer and what they tell you to do. There's no harm in taking the Medicare Part A. It's free to you if you have worked and paid in your 40 credits. While you work, it would be a secondary payer, and your insurance through your current employer is your primary payer for your medical care. Now, the one caveat to that is something that not a lot of people know about, and I don't know if it's offered at the university, so I'll just speak briefly about it. If you have a health savings account, not flexible spending account. Flexible spending is pre-tax dollars going into an account that you can use to reimburse yourself for copays. A health savings account is one in which you take very large sums of pre-tax dollars, put into a separate account, and then you enroll in a high deductible insurance plan through your current employer. And then as you incur expenses, because you got that really high deductible, you're pulling money out of that HSA. The IRS says you cannot have Medicare A if you have an HSA. So that would be the one case where you would really need to be careful in enrolling for Medicare Part A. If you have an HSA, boy, you'll find out quick because they'll tell you. And then we'd have to withdraw that Medicare Part A.
I have an online question.
Sure.
Okay. If only one person is retired and eligible for Medicare, how is the Medicare premium determined if you file your annual taxes as married filing jointly? Is it based on the income of the eligible person, or is it the AGI split evenly?
It is determined, and I hope everybody heard that so I don't have to repeat that long question. Medicare premiums, that Part B premium that I talked about, the standard amount is $134 per person per month. However, in 2006, a law was passed that says if you are a high earner, you may pay more than $134 a month or whatever that standard premium is. When they determine every year how much your Medicare premium will be, that office is looking at your tax return from 2 years prior. So a 2017 Medicare Part B premium is determined by your 2015 tax return and your modified adjusted gross earnings. And it is divided into categories: single, married filing jointly, married filing singly. That chart is available to you on the Medicare website. You may pay the $134 a month plus a substantial portion more. as determined by your modified adjusted gross income. Now there is hope because that determination is made every year, and at some point you're going to get beyond that high income that you had when you were still working, and you would just fall into the regular category then. Or the law says if you've had a qualifying life-changing event, I may be able to use a more recent tax year with your modified adjusted gross income. Those inputs are done in the office. There is a form to fill out that is available on our website, and that is called an SSA 44. SSA 44. And if you print that out, you can kind of just walk yourself through. It's very simple. You need to find out if you have a qualifying life-changing event. I don't have them all memorized. Work reduction is one of them. Work stoppage is one. Death of a spouse is one. So it's a pretty liberal policy, and very often we can adjust that back down to the standard premium. But that's an excellent question. I do have brochures on that as well here in the building today. Hello.
Thank you for the presentation.
My pleasure.
I have a question. If I'm planning to retire in a government place,
Yes.
what would happen to the benefits if I move to another country, let's say Costa Rica?
There are other countries. I'm sorry. The question is, if I retire and I decided to leave the cold weather of Michigan and go to a much more tropical climate like Costa Rica, can I still pay your benefits? That's an excellent question, and it varies. It depends on of what country you are a citizen, and it depends on whether we are allowed by law to send money to that country. Now, there is a whole brochure on that on our website. You can find that information. Generally speaking, if you are a U.S. citizen, there are a great many countries that we can send your money to, obviously by direct deposit. I will say that in some cases, it is easier to change and add that direct deposit once you move to that country by going to the consulate or the embassy there, rather than having us try to change it here. We do everything in the office to do that, and sometimes it doesn't work as well. And sometimes it takes longer than you would want it to work to have to wait for that money. So if you're going to be in that other country, setting up some retirement living, maybe visit the consulate and see what they have to say about that. These are really great questions, you guys.
I have an online question.
Sure.
When you collect SS benefits, does your online My Social Security page go away, or can you still have access to it?
So if you have a My SSA page of your own, account of your own, it doesn't go away once you begin to receive your benefits. In fact, we encourage you to keep your password up to date about every 6 months, because you can do many things there that you used to have to come into the office and do. For instance, change your address, change your phone number, change your own direct deposit information, print your 1099, get a new Medicare card, get a benefit verification letter in case you've decided that you would like to buy a second home. The bank may want to know how much money you have from Social Security. You can print all of that at home. Now, there are people who don't have printers at home. When I say printed at home, I really mean at the library, at home, wherever you have access to online services and wherever you feel safe accessing your account. I don't know if a coffee shop is the right place to do it, but libraries are pretty safe. You're welcome.
I just want to clarify if I understood this correctly.
Sure.
For Medicare Part B, if you retire and are eligible for the university's retiree benefits, it's not necessarily so that you have to apply for Part B?
No, we're going to clarify the Part B enrollment question. We'll revisit that. So you're getting ready to leave the university. And in retirement, the university is going to provide some medical coverage for you. You still need to enroll in Medicare A and B and pay that monthly premium, because the Medicare law says you can only delay filing for Part B if you have current employment. Social Security has no way around that. That's Medicare law, Medicare policy, and we can't do anything to change that or alter that in any way at all or ignore it. So once you separate, you need to enroll in Part B. I generally tell people come in the month before retirement or the month of retirement. Because what if this would never happen here? What if the form wasn't filled out correctly by the university and we need to send you back? When you enroll in Part B determines when your Part B coverage begins. I never want anybody to have a gap in their coverage. I always want you to have the greatest amount of choice so that you get your Medicare coverage when you need it, especially that Part B. Does that help? So if you're leaving the university, come and see us. Our office. Our office. HR does have the forms. I'm very pleased to say that HR here at the university does have both of those forms that I mentioned, and they are very, very good at filling them out.
I have an online question.
Sure.
If one continues to work after age 70, is there any benefit in delaying the SSA retirement benefits?
The question is, if you're going to continue working past age 70, is there any benefit to waiting until after 70 to file for your monthly payments? And that answer is no. There will be no more increase due to waiting for the benefit to begin after the month you turn 70. However, if you continue to work after 70, you're drawing your benefits, you continue to work, we're going to continue to recompute your benefit. As long as you're paying in, we're recalculating your benefit. If we owe you money, we'll raise your monthly benefit and we'll pay you what we owe you. We don't pay interest, but we do pay the money. Yes.
I have a question about the benefit for child disabled before the age of 18.
Yes.
And understood that they're can draw up to 50% at whatever retirement age.
Right.
But if there's a spousal benefit and you have a child disabled, does the spousal benefit decrease?
I'm just going to restate that. So if you're a retiree or preparing to retire, and you do have a child who is disabled before the age of 22, the child is potentially eligible for 50% of your amount, and your spouse is potentially eligible for 50%. Yes, there is a possibility that there could be a decrease in your spouse's benefit. For every person who works and pays in, we figure out that age 66 amount, that full retirement age amount. Then we figure out your family pot, I call it. So I can pay a spouse or a disabled adult child up to 50% as long as there's room in your family pot. If there isn't quite enough room, then the spousal benefit generally is decreased a little bit. Now, if your spouse took it early, and that's a lower benefit because of taking it early, there might be enough room. There's also a possibility, and this is pretty complex, that if your spouse has a work record and receives on her own and on yours, and we want to add the disabled child, we're going to add the disabled child to both records, yours and your spouse, and I'm going to look at the computations and see if I can do something called a combined family maximum. I would combine your family pot with your wife's family pot and increase everybody's benefit. Those are very specific computations. We would do them automatically for you if this occasion should arise.
I have an online question.
Sure.
If my wife was born in 1953, but not drawing SS yet, could she file and suspend, and I pull half of her SS benefit at age 62, then revert to mine later?
So that question is, if you are younger than full retirement age, can you file and suspend in order to allow your spouse to draw half of your full retirement age amount? That's where that law change came in. Number one, if you are under age 66, you cannot file and suspend. The only time you would file and suspend under age 66 is if you went back to work. You met the retirement requirements at the time you filed. You decided to go back to work. You reported it to us, and we put you in work suspense. You're making too much money to draw. In that case, no one is going to draw from that record. The file and suspend is no longer available unless you were born before January 2nd, 1954, and she was, because in this example, she was born in 53, but she's not yet full retirement age. So no file and suspend before full retirement age.
Thank you for taking the question.
Absolutely.
I still don't quite understand how the spousal benefits work. My wife plans to retire at age 62 next year.
Mm-hmm.
I will be age 68 and a half then, but I plan to keep working and not file for any benefits for myself. So when she turns 62, does she get a choice between taking her retirement benefits and half of mine, or what mine would be, or what?
The question is, if your spouse is less than full retirement age, can she choose to take her own reduced benefit, or can she choose to take half of yours? And the answer is, if you are under full retirement age, you must file your own benefit first. And that has always been true. That has never changed. So she would have to take her own retirement, reduced retirement, and then we would compare, even though I'm paying her less than full retirement age amount, down here at 62, at 75% of that amount, I have to compare her full retirement age amount to your full retirement age amount. And if you're receiving benefits, she can get maybe a little bump up. If her age 66 amount is less than half of yours, she can get some additional monies from you, but only if you file. Only if you file and receive your benefits.
I have an online question.
Sure.
The Medicare premium is determined by your latest tax return. After retirement, your yearly income declines. Is the Medicare premium adjusted annually as your income declines? Which one is reflected in your tax return?
So that question is an excellent one. We talked about it a little bit, but it's important to go over that again. When a Medicare determination, Part B premium amount determination is made, it is made every single year. When they make that determination, they look at your tax return from 2 years prior. If the tax return from 2 years prior is not available, they're going to go back 3 years. That does happen occasionally if you have filed your tax return late, you filed an extension and it just, hasn't come in to us yet. So the law does provide for a reduction in premium if you have had a life-changing event. Retirement is a qualifying life-changing event. So you would fill out that SSA 44 that's available on our website, and you would tell us, hey, can you use, instead of my 2015 tax return, would you please use my 2016 return because I retired in 2016. If the 2016 modified adjusted gross income is still not low enough, because maybe you had a big payout when you left, or maybe you retired very late in the year, then I can actually use the current year. I can use an estimate of your modified adjusted gross income for 2017. If you are wrong and it comes in much higher, you will then be charged that higher premium for that whole previous year. So it behooves us to give the best estimate that we possibly can, so that you don't get hit later with owing all of that money. Question in the back?
Yes. Hello.
How are you?
If I began receiving Social Security at age 62,
Yes.
and then at 64 got the great job offer and wanted to go to work, can I stop Social Security at that time?
Yeah, that's a very good question. So you've taken, say, theoretically, you've taken your reduced retirement at age 62, and 2 years later at 64, you get this great job offer, and you want to take it. You can go back to work. You just communicate with us. You tell us exactly this scenario. I'm going to take this great job. I'm going to be making $50,000 a year here when I didn't expect to earn any more. And we input for you an estimate of your earnings onto your master record. And our system recognizes that you're going to make too much money. And so it will suspend you for the proper amount of months so that you don't owe us at the end of the year. There is one other way to do that, and that is to withdraw the retirement application if that job offer comes within 12 months of your filing. You can withdraw the application and pay back everything we've paid you, and then someday in the future, start all over again. It will be as if it never happened. But that withdrawal option is only within the first 12 months from the filing date. Otherwise, we would just put you in work suspense. You'll stay in work suspense until full retirement age, or you call us and tell us, nope, I've stopped working. Here's what my earnings are expected to be. And we update that and pay you based on whatever your earnings estimate is. And to figure it out, we just take, say you're going to make $50,000. We subtract the allowable earnings of $16,920. That result is divided by 2, because you owe us $1 for every 2 you go over. And then that figure is divided by your monthly payment amount. That tells me how many checks I have to withhold. Maybe I have to withhold 2.9 payments. I'm going to withhold 3, just to be sure. The following spring, when your tax return has come in and we've got all the information we need from IRS, we will recompute it and say, did we keep enough money? Did we take too much money? If we didn't take enough, you're going to owe us the money anyway. If we took too much, we refund you what we owe you. So it is possible. And it happens pretty regularly.
We are taking our last question online and also in the room. And that question is, if I was married 20 plus years, my husband is now full retirement age, and I'm currently working. This person was born in 1949. How does his SSA and my SSA work for me when I retire at my full retirement age?
That's a very good question. I want to make sure I understand it. This person is born in 1949.
Yes.
And her husband also born prior to that 1954 date that I talked about. Is the husband drawing a benefit?
It says he is now full retirement age, and I am currently working.
Okay, so it sounds like maybe he's already drawing. We're not sure about that. And maybe the wife is working, if we want to talk about it that way. So you would fall under the old rules. And the old rules say that at age 66, you can decide whether you want to draw half of your husband's full retirement age amount or take your own. If you draw half of his full retirement age amount, your own remains untouched and it grows until age 70, or you tell us sometime between 66 and 70 that you want it to start. Old rules apply in that situation, but the spouse, that one that's not working, they have to be drawing a benefit.
She's just sent in a clarification.
Okay.
Husband is drawing a benefit, but we are divorced.
Okay. Well, that's important. However, you were married 20 years before divorce. So number one, I would need proof of marriage and divorce. And the rules are the same with one caveat, and it's better for the ex-spouse. If he is at least 62, whether he has filed or not, you meet the 10-year marriage duration, you've been divorced for at least 2 years, and you're under the old rules, you can file on his record, even though he hasn't filed yet. That's the only case. That's called independently entitled divorced spouse. It's a very specific segment of the population.
We are at the end of our presentation, and I want to thank everyone for attending today. This presentation will be made available online, and we will be sending out an email in order to let everyone know that the video is actually posted and available to be seen. If you have further questions, we are asking that you would please send your questions to benefits-programs@umich.edu. Again, if you have further questions, please send your questions to benefits-programs@umich.edu. I'd like to take this time to thank Ms. Zorn for all of her expertise and answering the questions.
Thank you. I appreciate coming and talking to you today. It was a pleasure. Thank you.